Welcome back to another edition. I recently wrote in a column, and I think I repeated it on an interview on South Dakota Public Broadcasting, that we are in the silly season of politics. Nothing unique about that statement. I certainly didn't coin it, but it is very true, especially again this year as we are approaching a presidential election. There are very strong opinions on both sides of the aisle, and a lot of polarization in this country. I don't need to tell you that. And I thought it was interesting and worth talking to you about. Financial Planning Magazine posed the following question to 320 financial advisors. They asked, how will the U.S. election outcome influence retirement planning, and what steps are you currently taking? I thought this was intriguing, especially the results of the responses, which revealed that a stunning 9 out of 10 advisors, financial advisors, anticipated a lasting negative impact on their clients' portfolios as the result of the coming election. And some of these advisors were advising clients to divest from equities and increase cash positions in anticipation of the election. In fact, one expressed concern that with the equity markets near all-time highs, the uncertainty surrounding our future president is a significant factor. Well, I think all of us would agree this survey perfectly frames the dramatic election climate that we're in 2024. Yet stunningly, this article ran on September 13th of 2016, almost 8 years ago. At that time, it seemed inevitable that Hillary Clinton would be the next president, much to the dismay of Trump supporters, and especially those Trump supporters who bailed out of the market assuming she would win. I remember that time. In fact, I had a number of bets. I kind of enjoy betting, not compulsive gambling as such, but the competitive part of me enjoys a good bet. And I had a number of bets with clients, especially those who were strong Trump supporters, that Hillary Clinton would win. I didn't think there was any way that he would be elected, which was pretty surprising given the fact at that time I'd been a fiscally conservative person. Well, I lost a lot of bets. And I did have clients that bailed out of the market in anticipation that Hillary Clinton would win. Well, instead, Trump won, and we kind of went through the same thing again in 2020. The polls prior to the election indicated Biden would win, which he did. And again, some Trump supporters bailed out of the markets to the detriment of their financial well-being. So it's interesting when we go into the research of political events, especially presidential elections, that oftentimes the market doesn't care, certainly long term. And often what happens short term is equally surprising. Basically, the majority of advisors responding to that 2016 survey, when the thought was that Hillary Clinton would win, were doing nothing different than their clients. And often the message to the brain, whether it's a client's brain or even a financial advisor's brain, is when things look rocky, let's bail out. So many advisors, and I knew several of them, took their clients out of the market. Well, this was not good news for their clients because the markets moved upward sharply. And I will contend, and I have often contended, that one of the biggest values, and the research even bears this out, one of the biggest values of having a financial planner is keeping you in the markets during downturns. So those advisors whose own political anxiety and fear led them to convince their clients to bail out failed those clients in a big way. So one real takeaway here is that financial advisors have the same brain that their clients do. They do have more education. Some of them have done more work. In therapeutic circles, you would call it countertransference work on the fears and emotions that parts of them can have when markets are declining, the fear of facing clients and telling them that they've lost money, the projection that they have around that. And as a result, some can act very poorly. I remember in 2008, a lot of financial advisors got their clients out of the market in the late fall to early winter 2008, 2009, during that period of time, which was really near the market bottom, and did their clients great harm. And I remember a prominent newsletter writer to the financial planning profession saying, we're going to have to rethink everything around what we thought was true here. We may need, in so many words, he was saying, we may need to start timing the market, giving into all of the emotions and acting out on fear and anxiety, rather than acknowledging and dealing with those emotions and then following the research, following the path that was laid out before the markets crashed. In other words, during a calm time for your internal financial system, when you're looking at logic, you're looking at reason, everything is calm within, and you decide on a course of action, a certain portfolio. You look at the standard deviations, that's the market volatility that can happen. Your head nods, yes, I understand. And when markets decline and that anxiety and fear gets triggered in those parts of us, it's so important to acknowledge the fear and the anxiety. It's important not to try and resist it or cover it up. It's important to acknowledge it and then turn back to what was decided on in a time of calmer emotional waters. So I think this is important to understand, but kind of back a little bit to my topic is that the more strongly people buy into the rhetoric of their political parties, the more difficult it is to be pragmatic about our investments. And this is really, really important to grasp. I've witnessed this play out every 4 years when we elect a president. And I'm no longer a spring chicken. I have a number of presidential elections under my belt. In every one of them, I've had clients wanting to get out of the market because they were absolutely confident of what was going to happen in the marketplace and who was going to get elected. And I can tell you that not one of those clients that ever acted on that gained. It always seemed to be a surprise, and it always seemed to go against what they thought would happen. I mean, to the point that they would get out, the president that they feared was elected, and the markets went up. So this is something really important to embody, to look at while we are in more pragmatic or more logical states, when those parts of us are up in thinking. It's important to hear this research. So if this has been going on within you, a fear of who's going to win the election, we've been through a period of time where in a month it looked like the candidate who was going to run away with the election, which was Donald Trump, within 30 days the tables were flipped, and his the opposing candidate, Harris, was now ahead almost an equal amount in the polls, at least in the battleground states. And I can hear it coming, of the fear and the anxiety that's going to unfold. It doesn't matter which of these candidates win. The fear and anxiety and projection of what that means for the U.S. and what that means for markets is equal on both sides. So as you probably can guess, as a financial planner and a financial therapist in 2016 and in 2020, I encouraged everyone, regardless of their political affiliation, to stay the course, to not do anything. Now, certainly, I have my biases. Certainly, I thought I had an idea who was going to win. Certainly in 2016, I did. And I knew it was important for me not to act on those biases. So it the chances are good that during the 4 years of the next president, that the stock markets will tend to go up. They will tend to be higher than when they took over in the office. And the research would indicate that whether there's a Republican or a Democratic sweep of the presidency and Congress, that the markets will tend to go up. And of course, if you're a Democrat and you think of a Republican sweep, you tremble with fear. How can that possibly happen? And the same thing is if you're a Republican and the Democrats sweep, there can be a lot of fear about that. Polls tell us that 42% of Americans are in the middle. They're not heavily Democratic. They're not heavily Republican. They can tend to swing one way or another, but they're more in this middle ground. And so I would hope that 42% of Americans may be more pragmatic in how they approach the markets. I'm not sure that that's true. They still have brains and they still can get triggered, and especially if you open your email and read the spam and junk mail that you get with screaming headlines of, a depression will happen if Harris is elected or Trump is elected. I mean, candidate Trump has said we are on the verge of a depression. With things like that, it can sometimes be difficult to keep from anxiety taking you over, parts of you that are very fearful when you hear that, and hear that from such an authoritative figure. Going back to history, in 2016, and much to the chagrin of Clinton supporters who feared if Donald Trump would be elected that it would be disaster, the Dow Jones Index actually increased almost 7% between the election day and Trump's inauguration day. And the market continued to rise a total of 19% between his election and the next presidential election day. So it was not Armageddon. It was not bad times. And this, of course, the Republican Party looks back at this and says, well, things were pretty good, weren't they, under Trump? Well, let's look at what happened in 2020. And much to the shock of Trump supporters, the Dow rose 30.5% between Election Day and Biden's inauguration day. Since his election, the market is up 22.5%. We've seen new all-time highs on the Dow. So actually, the market has done better, just slightly, under Biden than Trump. Now, this is so hard to hear if you're a Trump supporter, and this was so hard to watch if you were a Hillary Clinton supporter, because we convince ourselves through confirmation bias and all of the fears and the biases that we bring to the table, that good things cannot happen if my party, my philosophy, is not the prevailing party in the White House or in Congress. So the point that I want to make is that neither election brought the lasting negative economic impact on clients' portfolios that 9 out of 10 advisors feared in 2016. Those advisors' clients suffered greatly. They missed out on a total rise of 20% in Trump's, and if they stayed out, 22% so far during Biden's presidency. So just let that settle in a little bit to the parts of you that are so fearful about the, quote, takeover, end quote, of the other party. And certainly you may have a part of you that's saying, well, this time is different. It's never been that bad. When you do research, sometimes that doesn't hold up. Certainly, I'm not minimizing that things aren't bad when it comes to polarization in the country. But our economy and the foundation upon which we are built as a country might be a little more resilient than what parts of us fear that the economy is. So the point that I'd like you to take away from this is that the stock market is highly unpredictable during times like this, just as the events themselves are unpredictable. The best course of action is maintaining a long-term perspective, because over the long term, our stock markets and bond markets tend to go up. Now, there have been times in our history where we've had 10-year, even 15-year really down markets. They're not normal, but they can happen. It's just foolhardy for parts of us to believe that we can time the market, that we can sell high and buy low. And it's a very emotional response. 90% of all financial decisions are made emotionally. And it's important that we have what IFS would call self-energy to manage all of the various parts of ourselves, all of their fears and anxieties, and really bring a sense of calm and courage, confidence, clarity to events like these, and make decisions from a real calm state of being. Timing election markets can lead to missed opportunities and financial losses. So as we enter this time, let the lessons of 2016 and 2020 remain really pertinent within all the financial parts of yourself that are reviewing this data and making decisions about your financial well-being in the future. Can there be short-term market swings? Absolutely. Have we been in a recession? We've talked about that. Absolutely not. Will there be another recession? Absolutely. You've heard me say many times that there's a high probability of a bear market, which is a market that's going down, that drops more than 20%. The average bear market drops 42% from the high. And there's a high probability of that happening during the first 18 months of any president's four-year term. Any president, not just Republican, not just Democratic. And we've had a long run with the stock markets. We've seen the Dow at 40,000. That was a pipe dream back in the 80s. I think there were books written, Dow 40,000, and you're just like, oh, come on. But that means we could have a recession where we see that the Dow dropped to 32,000 to 24 or 5,000. Wow. And it's normal. It's not a time to panic, and we need to work with that and work with those emotions that will get so triggered during that time, and wonder, is it time to get out and try to salvage something? Of course, the opposite action is almost always the action to take, which is if you're not invested or you have some money, put it in, and certainly keep putting in new money during that time. So I hope this is helpful. Like I said, I say this every 4 years. The best way to election-proof your portfolio is to leave it alone. So thanks for listening, and I just want to remind you, if you have questions, please reach out to me at rick@rickkahler.com. I do have a article that I write every week that can be found at kahlerfinancial.com, clicking on blog, or advancedwellbeing.com. I think also clicking on the blog. Those are two different articles that come out. The one from Kahler Financial tends to be a little more financial in nature. And typically with these podcasts, I will often take, as I did today, an article that I've written. Again, I write an article every week. It goes out on a distribution list. It's in 4 or 5 newspapers and several virtual publications online. And I try to expand that column because I have a lot more than 600 words on the podcast, and bring in the emotional component of that column of what's going on behind the scenes within ourselves. So, and again, if you need more information on IFS Informed Financial Therapy, you can find that at advanced-wellbeing.com. So again, thank you for listening. I look forward to hearing your feedback. So take care. Talk to you next week.